Big risk, though, is these 7 tech stocks, which represents 50% of the value of the S&P. And if you look at the risk is all there. And this next slide here, you see that this index here is the S&P 500 with the Magnificent Seven in it. Well, that is the Magnificent Seven. And then you've got the S&P index, weighted index. If you take out the Magnificent Seven, the index itself has actually been flat since 2022 when the market bottomed out. So all the risk in the S&P is on those 7 stocks. So when those 7 stocks do pull back or correct significantly, it's going to be mostly those stocks that take the hit permanent, because what's going to happen is there's going to be rotation out of the Magnificent Seven into the other stocks supporting those stocks. And here's another graph that shows that most of the risk is in the US. This is, again, the S&P 500 US market, and these are all the other markets. And this is called the price to book ratio, which just shows that the S&P the S&P is considerably way overpriced compared to the rest of the world. So most of the risk is in the US. So if you have a portfolio that's diversified outside of the US and not into the Magnificent Seven, you're not going to see a significant correction in your portfolio.